Okay, so if you've ever traded stocks or crypto, you know you've basically stepped onto a battlefield. But it is definitely not some chaotic free-for-all. It's actually a highly structured environment where everyday retail traders are constantly colliding with these massive institutional players, the so-called smart money. So let's just dive right into this explainer, because we really need to unpack how the explosive rise of decentralized exchanges, or DEXs, is completely, radically altering market liquidity for literally everyone involved.
Have you ever felt like, I don't know, the market is literally watching you? Like you buy into what looks like the perfect breakout, and then suddenly, bam, the price sharply reverses on you. It's so incredibly frustrating, and it begs a pretty serious question. Are retail traders ultimately just acting as liquidity for institutional giants? Well, spoiler alert, it's not a conspiracy theory. It's actually a thoroughly documented market mechanic. You see, when you and thousands of other people place orders around the exact same, super obvious chart levels, you're essentially creating this massive pool of liquidity.
There's this really fascinating insight from Binance Square that kind of hits the nail on the head here. They point out that smart money knows exactly where that liquidity is resting. Think about it. Institutions need massive amounts of fuel to execute their huge positions without completely crashing the price of an asset. And where do they get that fuel? Yep, from retail stop losses and breakout orders. A quick, calculated push beyond a key level triggers an absolute flood of retail entries, which allows those institutions to quietly just step in and take the exact opposite side of the trade.
And look, this isn't just happening by chance, right? Research into what's called internalized order flow reveals a very specific pipeline. Basically, wholesalers observe this massive institutional demand, and then they intentionally route incoming retail orders to the opposing side. So completely unknowingly, retail traders end up providing the exact liquidity that institutions need to plug their gaps. When institutional liquidity is scarce, middlemen are actively out there using your retail order flow to balance the scales.
So researchers actually split this whole dynamic into two camps. First, you have informed trading. This represents the institutions making these huge, data-driven, price-moving trades. On the flip side, you have what's called uninformed or noise trading. That's the retail traders who are really just looking for immediate execution. Maybe they're acting on a margin call, or they just have an immediate hedging need. The bottom line is, retail wants speed, while institutions absolutely need deep liquidity so they can hide their massive footprints.
But here's where things get really interesting. Because to solve this liquidity problem, the market is undergoing a massive, fundamental shift right now. Over just the last 5 years, the ratio of spot trading on decentralized exchanges compared to centralized exchanges has literally more than tripled. It is explosive growth, and it's being driven by automated market makers, or AMMs, which are just completely dwarfing traditional order book models in the decentralized space.
And these AMMs, they are a totally different financial engine. A DEX doesn't have a traditional limit order book. There are no actual buyers and sellers sitting there waiting to match with you. Instead, they use these things called constant function market makers. The price isn't negotiated between people. It's strictly 100% dictated by a mathematical algorithm based entirely on the assets that are locked directly inside a smart contract. To really picture this, think of the algorithm, specifically the constant product market maker, as a giant mathematical seesaw. The rule is that the total quantity of token X multiplied by token Y must always equal a constant number. Always. So if you go in and buy a large amount of token X, you're removing it from the pool, right? Well, the algorithm automatically forces the price of X up. The less of it there is in the pool, the more expensive it gets. It's really that simple.
Now, because of how this curve is physically shaped, it's convex, we get what's called asymmetric price impact. Essentially, taking liquidity out of the pool is going to incur a much higher price impact than putting it back in. If you try to execute a massive trade in a really shallow pool, the price is going to slip exponentially against you. It's going to cost you. Therefore, this whole system absolutely requires massive, super deep liquidity pools to even function for the large players without triggering these wild, extreme price swings.
And that brings us to the absolute aha moment of this whole explainer. When you look at the economic modeling, you see traders naturally segregating themselves. When market volatility spikes, institutions actually flee the centralized exchanges because they want to avoid massive slippage. Instead, they cluster on DEXs to hide behind those incredibly deep algorithmic pools. Meanwhile, retail traders are clustering on the CEXs because they're demanding immediate, fast execution, and they don't want to deal with the slow processing times and variable fees of interacting directly with the blockchain.
Okay, but wait, here's the crazy plot twist. You would logically think that all these massive institutions fleeing to DEXs would just leave retail traders completely out to dry on centralized platforms, right? Actually, no.
Research points to the exact opposite. Believe it or not, this institutional migration is secretly a massive win for retail traders on traditional exchanges.
And here is exactly why that happens. When the informed institutional traders pack up and leave for DEXs, they take their dangerous, toxic order flow with them. For centralized market makers, trading against those massive institutions is incredibly risky. So removing that danger means they face way less risk overall. And because they have less risk, they can actually offer much narrower bid-ask spreads. Literally, by drawing the smart money away, DEXs make trading significantly cheaper and tighter for everyday retail traders. It's wild.
But, it's not all sunshine and rainbows. There is a very real, hardwired risk to this new decentralized system, and it's called impermanent loss. When informed traders make large directional trades based on new information, they are systematically extracting value from that liquidity pool. The people providing the liquidity end up holding more of whichever asset is less valuable at the time. It is literally just the cost of doing business against smart money in a perfectly mathematical market.
So we've really seen how this entire battlefield is shifting right under our feet. Wholesalers are routing retail flow, institutions are hiding in deep mathematical pools, and the very act of trading is just being handed over to smart contracts. It really leaves us with a provocative thought, doesn't it? If algorithms and constant product curves completely replace traditional brokers and human order books, who actually holds the power now? Who becomes the new smart money when cold, hard math is what dictates market liquidity? That is the big question that is absolutely going to define the next decade of finance. Thanks so much for joining me for this explainer, and hey, always keep questioning the mechanics behind your trades.